Hey traders and investors, it's Serge Berger here. I've been getting a lot of questions, particularly last Friday, on what's actually happening in the broader market environment and why things are so choppy. And I think, it's only fair to go into this a little bit more detail, so I'm happy to shed some light on it because it has been very frustrating from an equity perspective so far this year. Before I get into that, real quick, I want to mention that this Tuesday, on March the 10th, my friends over at tradingwins.com, so that's tradingwins, wins.com, are going to be holding a webinar, a free webinar, and they'll explain a winning momentum strategy. I do think it's a terrific idea to go over the strategy at this point where the markets are, so I'll definitely encourage everyone to tune in. If you want to sign up, it's tradingwins.com/class. Tradingwins.com/class. You can sign up for that free webinar to learn a winning momentum strategy. Again, I'd encourage everyone to sign up for that. So what's happening so far this year is that if we look at the stock market, the U.S. stock market, the S&P 500 is basically flat this year. We've had a very choppy January. Then in February we had a 6% rally, and after Friday's drop, we're basically back to flat performance year to date, right? So that's number one. If we look over to Europe, however, look at the EWG ETF, which kind of represents the DAX. We had a very strong rally, more or less right off the bat and early in the year. And the DAX was up like 10% at some point just a few days ago. It's now up about 7% year to date. And that's important to understand because the reason behind that is because of the differential in the interest rate differential between Europe and the US. So basically in Europe, they're still being more accommodative. So the more QE, interest rates are going to be lower for longer, whereas in the U.S., the Fed continues to reiterate that they want to raise rates at some point later on this year, and that's why we've seen in the U.S. a very big rise in yield. So the 10-year Treasury note in yield terms in late January, early February was about 1.65%. On Friday, we closed out about 2.25%. Okay, that's a very big move for interest rates. So that's kind of turned a lot of things upside down, and this move in interest rates, this year has basically kind of almost been like a V-shaped reversal from December. We dropped in interest rates all the way to late January, and then we've had a big rise in interest rates, and that's kind of made the equity markets choppy. That's made that's caused more a tighter range, but uncomfortable tight sort of volatility or choppiness in many other markets. Okay. And that's been the problem. And until this is resolved, things are probably going to remain choppy. So what's important to understand here now is that we keep hopping from one ECB and Fed meeting to the next. And the next Fed meeting is, if I remember correctly, was March 18th. So it's a couple of weeks from now, where they're either going to have to confirm that these interest rates are indeed going to rise in June or September or whatever. And that'll probably keep rates elevated, i.e. they're going to continue to rise, or the economic data that we've seen of late, which has been mostly deflationary, you can go back to the CPI numbers and everything we've seen, will indeed keep the Fed from raising rates anytime soon, and that'll completely reverse this entire move. So until this is clear, or clear is always a relative term in markets because nothing's ever really clear, but until we get a little bit of clarification, I should say, by the Fed in a couple of weeks from now on this, I do think this market's going to be very, very choppy to trade. You can look at single name stocks if they've traded very choppy. Of course, the broader market has. So I'd encourage everyone to take a step back, not do a whole lot of work the trading. Most people that I know that are doing okay this year or holding up are those guys that didn't trade too much. So I'd encourage everyone to do that as well. That's not something your broker's going to tell you. But indeed, low probability environments do not really encourage trading. There may be some stuff to do via options here and there, but at the end of the day, this is an uncertain environment, and the risk is pretty high that we'll see a much more meaningful volatility here at some point over in the near future. So I hope this makes sense, guys. Again,
target has been reached.
Again, go over to tradingwins.com/class to sign up for the webinar for winning momentum strategy tomorrow, March 10th. Otherwise, you can hit me up on Twitter. My Twitter handle is SteadyTrader. And I'll see you in the next video.